Thank you, Allie. I'm Mike Carrazzo, your host for a segment we call Cup of Joe. Joe in honor of our founder, Joseph T. Ryerson. It's meant to be a casual and interactive discussion into current conditions in the commodities market, much like we're just sitting down and chatting. We do Cup of Joe the first Thursday of each month, and we're honored to be part of this great engaged lineup. And speaking of honored, that's what I feel each episode when I get to pick the brain of this man right here. He's our Director of Risk Management, Commodity Hedging, Nick Webb. How you doing, Nick?
Mike, I'm doing great. How are you doing?
Doing well. So
happy to be here for this is the fourth engage now?
It is the fourth engage, yes. And I believe you've been a part of all four of them.
Yeah, that's right. It's been a blast.
Yeah. And we've heard some really good segments so far. We just came off of Alan's, and I think a lot of what you're going to be talking about will dovetail nicely into that. So why don't we hop right into it?
Excellent. Yeah, so as you had mentioned, given the fact that we've already heard from Alan on much of the macro side of things, I'm not going to cover nearly as much as we normally do on our typical Cup of Joe. I do still have a couple slides that I'm going to run through, just because I think it's a nice thing to have set the stage for where we are in the commodity environment. But the bulk of this is going to be covering the metals markets, what we're seeing, key trends, and we're actually going to dive into a number of new charts and tables that we haven't discussed in prior Cup of Joes. So I'm pretty excited about this one. We got a lot of new content, and let's go ahead and get into it. Before we do, have to cover the safe harbor provision, which is these are the opinions of Nick Webb, Mike Carrazzo. These are not the opinions of Ryerson as a whole. Do your own research. This is not investment advice, but let's have some fun here. Now, given the fact that we have an artificial intelligence covering manufacturing presenter here in just a little bit in Peter Zielinski, I wanted to do a little, I was curious if ChatGPT, which is a large language model, to see if it had the ability to do a better job than what Mike and I do in predicting where industrial metals prices are going in the future. So I asked a simple prompt to ChatGPT a couple of days ago. I said, what will industrial metal prices do in 2024? The good news for Mike and I, Mike, I think our jobs are intact, at least for a little while longer. The computers and they haven't taken over the world of commodity forecasting just yet. But what the prompt we got back was basically, you need to be watching things like global demand, supply factors, geopolitical issues. And that's the reason why we do Cup of Joe every single month, because these things are dynamic. They are changing all the time, and they are impacting metals markets and commodities markets more broadly. So this is why we do what we do. And for now, until the computers take over our jobs, we're going to keep doing it.
So what's encouraging is so many people put information in the ChatGPT that ChatGPT says, you know what? I can't say it any better than Cup of Joe, so go watch Cup of Joe.
That's right.
That's good. That's encouraging.
Yeah, until ChatGPT starts sourcing our Cup of Joe information into its model, I think we're good.
Yep.
Now, this chart is similar to what we've looked at in the past, which is normally the heat map looking at either 12 months or 36 months. Mike told me it was a little busy, so I tried to simplify it a little bit. What we're looking at here is PMIs, so that's the Purchasing Managers Index, for some of the key regions of the world. We've obviously got the global index shown in blue. We've got the US highlighted in kind of that deep red color. And again, this is over 36 months. We've then got Canada, Mexico, China, and the Eurozone, really the key manufacturing markets we like to keep an eye on. And there's one thing that I think should jump out pretty clearly is over this 36-month time period, there's something that happens right there in the middle of the chart. And it's really that most manufacturing markets, whether it's US or the global figures or the Eurozone, they really hit the skids in right around June, July of 2022. And there was something very distinct that happened and that changed at that point in time. And that was the Federal Reserve began their rate hiking cycle. So that was the Federal Reserve's effort, and really central banks globally, their effort to make business conditions a little more difficult, hiking interest rates, making it more expensive to borrow, to borrow for a home, to borrow for a car, to borrow for running a business. And that was true globally across these central banks. And you can see that it is having an impact on manufacturing markets. For instance, you look at that deep blue line, we've now been for about 15 months, we've been in negative territory. And negative, for those who don't know, is anything below this index level of 50. So it's not, from a magnitude standpoint, it's not deep negative, but it certainly is. It's been from a duration standpoint, it's been in negative territory for quite some time. You can see one of the big factors for that is going to be the Eurozone, which is shown down in the bottom right-hand corner, they've been in I would call recessionary conditions for the better part of 6 to 9 months at this stage.
What's nice about this, and as you mentioned, kind of consolidated everything, but what you normally show is what you affectionately refer to as the eye chart of all the different countries.
Sure.
What's really nice is when you see those pockets of the different countries, and there's been some surprising ones, right? Like, Russia continuing to maintain or even grow. And then from what I recall, over the past maybe year and a half, India's been a very strong region. So it's while we see like kind of the broader trends here, it's always good to kind of see those individual pockets as well.
Yeah, for sure. And keep that thought in mind. And for all of our viewers, we often get the question about Russia: how in the world do we explain that they're running above 50, which is growth? And as you mentioned, there aren't too many regions of the world that are in growth mode right now from a manufacturing standpoint. It's India, which is going gangbusters and has been for about 12 to 15 months. Russia, and then as you can see in this chart, you have a small bit of growth showing up in China in recent months, and a small bit of growth showing up in Mexico in recent months. But we will have a slide that'll touch a little deeper on the Russian data, which I think might pique some people's interests here in a few minutes. Now, the good news is, despite the fact that we are seeing some manufacturing softness, both on a global basis and in the United States, it's really a story of the haves and the have-nots. There are some pockets of pretty robust strength that we're seeing at the moment, and then there's some areas of the economy and the manufacturing world that are seeing some softness. I'm not going to read through all of them, but going left to right, over on the very strong side of things, you've got non-defense aircraft shipments that are tracking north of 25% at the moment. Now, the one caveat I will say is some of this data is a little lagged, so that may get impacted. Unfortunate situation that happened on Alaska Airlines a couple weeks ago with the door flying off. That could impact airplane shipments in the coming months. So we'll have to keep an eye there. But left to right, non-residential construction running very strong, construction machinery, HVAC, and the list goes on. There are a number of categories that are in growth mode at the moment. And then on the far right-hand side, the unfortunate side is if you're dealing in the space of boat shipments, farm machinery, industrial machinery, or household appliances, those areas are seeing a little bit of softness at the moment. So it is, it kind of depends on your geography, if you're a salesperson or if you're running a business in a certain geography or for a certain end market, you may be seeing a different, prospect for 2024 as you look forward.
Question: you've got some unique things happening this year, right? I mean, interest rates is well documented, have been on an upward, and then we're coming into an election year too. I'm curious, in aggregate, like, do those factors really have an impact on how these markets may be seeing the year ahead?
I mean, I think anecdotally, at least in my opinion, I think it makes sense that if you've got the end of a 4-year presidential term, if you're running for re-election, which is currently the case, I would say it is in their best interest to keep the market somewhat intact. So if that means keeping spending elevated, keeping markets a little more accommodative, whether that's monetary policy or what interest rate policy, I think that could be taking place, and we could see that take place in the coming months. In terms of what the impact is on metals prices, I don't have a slide specifically in this presentation, but my analyst and I actually went into a deep dive on determining it as we roll into the last year of a presidential term over the 4 years. Is there any impact on metals prices as we look across aluminum and copper and steel? And what we found was, if anything, there's a slight bias to the upside for that last term on metals prices. It's not massive. It is not definitive statistically. If I were to put odds around it, it's maybe 55 to 60% is the skew to the upside, and then 45 to 40% is to the downside. It depends on the metal a little bit, but I would say, we were hoping to find a little more definitive action or definitive data within that's the stats of basically the last 50 years. We didn't really find what we were expecting. So it seems to be fairly balanced, and that's balanced whether it's, depending on the president or even depending on the side of the aisle that president sits on.
Yeah, that's interesting. I'd see that. I would think there's one fluctuation one way or the other, but I'm sure we'll dive into that into some future episodes.
We would have too, because obviously different presidents have different trade policies. They have different monetary spending tactics. We would have expected there to be a bigger impact, and there really wasn't. And again, that's just looking at the beginning of the year to the end of the year. we didn't do a whole lot deeper dive than that, but just doing, beginning of the year, end of the year, there wasn't a whole lot of definitive data there.
Yeah, interesting.
So with that, let's go ahead and hop into the metals. First things first, on the aluminum side, we've got some pretty cool charts here coming up. But on the aluminum side, we've looked at this chart in prior couple of Joes. This is a 5-year chart of the London Metal Exchange aluminum ingot price. So this is basically the main commodity portion of common alloy aluminum. I've drawn in this horizontal white line. It's really acting to represent as that is the spot, roughly estimating, where a lot of aluminum smelters become unprofitable. It actually ends up being about 50 to 60% of aluminum smelters are not able to profitably make aluminum ingot when prices dip below that area. And we in the last couple of weeks have seen some smelters actually curtail production because they've said that due to higher costs of raw ingredients like alumina, bauxite, or due to higher labor costs, they're unable to successfully make money at current prices. So what you get is they say, well, we have to make a decision. Do we want to produce that extra pound of aluminum at a loss, or do we shut in production and hope for better market conditions in the future? The more they do that latter scenario of shutting in production, the better chance we have of balancing supply-demand dynamics, and that allows prices to recover and rebound higher. So I think if I were to put a skew on this chart or on aluminum prices generally, I think the skew certainly leans to the upside. Maybe not massively, because we do have some headwinds coming from higher interest rates and things like that. We may get some semblance of a recession as we roll through the later parts of this year. But in terms of just the aluminum price, we could see a scenario whereby so many producers just aren't able to make money that they have to shut in. You get balanced markets and prices can actually rebound a little bit. Now, on the aluminum premium side, so this is the Midwest premium, the premium to get aluminum into the Midwestern portion of the United States. I'm not going to spend a whole lot of time on this because for the last several months, it's been flat as a pancake. Obviously, we've seen a roller coaster ride for the last several years, but we're down sitting just south of 19 cents per pound, and it's been dead flat right around those levels. A lot of days it doesn't even budge on the index. So we won't spend a whole lot of time there, but 19 cents on the premium. I don't see a whole lot of risk that that's going to move massively one way or the other. Moving over to the raw material side, I touched on this anecdotally a couple slides ago, the idea that costs of smelting are going up a little bit, whether it's labor or whether it's raw materials. This is the raw material side of things. So this is actually looking at alumina prices, which is used to make aluminum. There have been a couple things that have taken place in the last couple of weeks. One is within Guinea, there was a bauxite explosion that caused the removal of a lot of the raw ingredient that goes into making alumina, which goes into making aluminum. So that's been one factor. The other factor is we've seen some curtailments of production, both within Australia and within China. All of those factors are combining to lift prices a bit in the last couple of weeks. And you can see it's not massive, but this should feed through to higher cost structures, which makes it a little more difficult for smelters to make money, down around the 90 cent to a dollar range. So I think there's a little bit of cost push support that's taking place on the raw ingredient side. Now, acting as a headwind a little bit in the last couple of weeks is aluminum inventories. You can see that for the better part of the year, LME aluminum inventories, so that's the London Metal Exchange, inventories that actually show up in those warehouses had been dwindling somewhat substantially over the last 12 months. Well, in the last 30 to 45 days, we have seen some fairly substantial aluminum inventories going into Asian warehouses. One caveat that I will say to some of this, though, is about 90% of the aluminum that exists in the London Metal Exchange right now is of Russian origin. And why is that important? Well, it's important for a couple of reasons. One is there are some countries that are not allowed to touch Russian material, which means that it's not really real inventory for some traders, some regions of the world. And then just kind of anecdotally, there are a lot of Western nations that don't want to, benefit the Russian economy, so they don't want to touch that material just through, principle, I suppose. So of this 500,000 tons of aluminum inventory that's sitting on the LME, the vast majority of it is essentially untouchable, which I would argue, at least for Western economies, means that it's not really a real inventory. Now, countries like India, countries like China, they may be more agnostic to that, and they may be open to taking that. And we're going to touch on that here, I think, in just one slide. So what we're looking at here, this is a new one, but this kind of centers around this question of, hey, Nick, hey, Mike, why are we seeing PMIs in Russia holding up so well? Now, on one hand, I will fully accommodate the idea that it is possible that because the PMIs are a survey, it is possible that they can be fudged a little bit. It is possible you can lie about the data, which makes them look a little stronger than what they otherwise are. I think there's another possibility that at least some of that manufacturing activity and commodity related activity could be getting supported by China and a couple other nations. The left-hand side is showing the European Union amount of imports that are coming in. This is just looking at aluminum, but I would make the argument that we're probably going to see this, similar data in things like crude oil, in things like natural gas, nickel. You can see the blue line is showing the percentage share that is Russian origin going into the EU. And basically since 2022, when the attacks on Ukraine took place, that percentage has dropped precipitously from about 30 to 35%, all the way down to close to 5%. Now, over on the right-hand side, you may be saying, well, that's really bad news for Russia, unless they're able to find another home for that material. And you can see over on the far right-hand side, basically since 2022, the percentage of Chinese imports of Russian aluminum has gone up pretty massively. So it looks like, and also when you look at the total level of all of the countries summed together, it is actually going up. So it does appear as though, at least in certain commodities, Russia is finding other homes, other venues to take that material, and it looks like a lot of that is China. So whether we like it or not, China is kind of bailing out the Russian economy, which is very, very heavily commodity oriented.
So I'm shocked that someone would fudge the numbers as you indicate, but so for the aluminum buyer, you looked at the ingot, the Midwest premium. This is Russia in this kind of region, the one to watch if you're buying aluminum, and kind of how that's shaking out and how that might affect your aluminum purchases.
Yeah, I mean, I think, yes, you got to watch Russia because there could be additional sanctions that take place that are more formal, more broad sweeping. But until or unless all countries of the world, really participate in these things, if China's still on the sidelines and they're accepting that material, they're big enough that they can move the needle almost single-handedly, as is, India. So I think the bigger needle to watch in terms of demand and where prices may go is probably more arguably China, both in terms of them taking Russian material, but also in terms of China's economy and China's manufacturing space is consuming still 50 to 60% of the globe's aluminum. So where China goes, so too goes a lot of commodity prices. The good news for those who want prices to go higher is there are aspects of Chinese economy that are doing pretty okay, mostly related to technological infrastructure. Those sides of the economy are doing pretty well. Their property sector is still very, very weak. I think the most recent data was showing double-digit declines on the property sector. So that's a big one. That's going to be a headwind for commodities prices. But the good news for those in the aluminum world is some of their copper-related industries, aluminum-related industries like technology infrastructure are looking pretty positive at the moment.
Yeah, sure.
And when we look at aluminum supply-demand balances, over on the far right-hand side, you can see 2024, 2025. And again, this is just one bank's forecast, but this is consistent with a lot of other banks, which is when you look at the very bottom of this, the global balance of supply-demand, it looks pretty darn balanced. It's very small surpluses expected in 2024, but you call that 300,000 tons in a 72 million ton market. That's basically a balanced market. So things look pretty well balanced. If we see a couple more curtailments of aluminum smelters, that could flip that. That could take that into bullish territory. So I think that's something we want to keep an eye on. And as you look forward into 2025, 2026, again, very balanced and even slight deficits as we roll through time. So again, in my opinion, I think the skew looks somewhat positive, maybe not taking things back to record highs like we saw back in 2022, but certainly I think the skew is slightly to the upside. And I would say that's the case even if we do get some manufacturing softness, something that looks like a recession. And this is, that forecast I just gave is not necessarily just my own. A lot of bank analysts tend to agree as well, which is, you look at the mean and the median forecast looking out over the next several quarters, there is an expectation that we're going to see slightly higher prices to the tune of about 10 or 15% in the coming quarters. Flipping over to nickel, I would say, at least in the short term, it's a very different story. We've talked about this ad nauseum in prior Cup of Joes, but we'll dig into this. This is a 5-year chart of the LME nickel price. And, as you're looking at this chart, it's a pretty wild one, particularly going back to 2022 when we saw the massive short squeeze. For those who haven't participated in prior Cup of Joes, the short squeeze was essentially there was one very large Chinese seller of nickel futures. Basically, they were trying to profit or hedge on the idea that nickel prices would come down. When that doesn't go your way, or said a different way, when prices go up, it can cause a lot of pain financially for those who are short, and it causes you to have to panic buy and get out of those short positions. Otherwise, you take a big loss. Well, we saw a situation 2 years ago where this one individual took losses that we've heard are estimated upwards of $20 billion. And there's that saying out there that says, you owe the bank $1 million, it's your problem. You owe the bank $20 billion, it's the bank's problem. And that's really what we saw back then, which was $20 billion probably would have been large enough of a loss to bankrupt the London Metal Exchange. It could have bankrupted several banks who were brokers or handling these trades of that individual. It could have been a real systemic issue for the European economy, the Chinese economy. But at the very least, what we did see was a lot of turbulence and a lot of hostility centered around the London Metal Exchange. There were a lot of lawsuits because on the other side of that trade, you had individuals who wanted to make money on the long side of the trade. Basically, they would profit if prices went up. The London Metal Exchange froze markets for several weeks and basically said, we're going to cancel 8 hours of trades. These long positions got massively reduced, and everyone was upset on both sides of this transaction. And a lot of people stopped trading nickel for that reason. Well, the LME did take some steps. They did begin to take some measures. They put trading bans around the price of really all of these metals, but particularly around LME nickel, that said on one particular day, the price of nickel can't go up by more than some percentage. Which helps to put a little more confidence into the market. One of the other things they more recently did was they began to step up the fast tracking of new brands of nickel onto the exchange. Why does that matter? One of the issues that the LME had was, at least on the exchange, there was this perception that the market was extremely tight because LME inventories were very lean, and they were. The reality of the situation was nickel itself broadly wasn't all that lean in terms of available supplies. It was just the type of nickel that was really robust in supply was class 2 nickel. The LME does not accept class 2 nickel. They only accept class 1 nickel, which is refined very like 99.9% nickel. Class 2 nickel, which is very abundant in supply, mostly coming from Indonesia, since it's not accepted on the exchange, it gave this perception to the marketplace that the market was tight. And, that caused a little bit of gamesmanship and a little bit of misconception about the broad nickel market. Unfortunately, even though nickel broadly was very abundant in supply, the price of stainless steel, which is linked to the LME price, went up massively because it's linked to this contract. So long story short, the LME about 6 months ago started saying, let's approve more companies to put class 1 nickel onto the exchange. That'll help to loosen up the perception of the nickel market. And it has been effective. In the last couple of months, we've seen this is looking at LME nickel inventories on the exchange. So again, this is class 1 nickel. You can see it's beginning to grow very, very rapidly. So it does look like it took them a while, but the London Metal Exchange is getting a little bit more credibility back in the marketplace. And unfortunately, for those who are in the stainless market, it has meant that the market is, or at least the perception of the market is very quickly loosening up, and prices are taking a hit. Now, where do we stop? Where do we find a bottom? Flipping back to the nickel price, there will be a point where we get so low on the price of nickel that the same phenomenon that I think we're seeing in aluminum will take place in nickel. We'll get so low that even the lower cost providers will have to say, maybe we should stop flooding the market with more and more nickel because it's just not economic to do so. I don't think we're there quite yet, but I think if we get down in around the 6 to 650 range, we may start to see more and more nickel suppliers saying, no mas, cut production, and then you start to see a better balanced supply and demand condition. It is worth noting in the last couple of weeks, we have seen an Australian miner curtail some production, and they noted it was due to the fact that they're just seeing such low prices. They can't do it profitably anymore. So one of the main reasons why we have seen inventories growing within the London Metal Exchange, one of the key producers within the global economy has been Indonesia. And this chart was actually kind of staggering when I saw it a few days ago. This is coming from Macquarie, which is an Australian bank. And I won't get into all the different grades of nickel, but what I do want to highlight is really the tops of all of these bars, which is total production of nickel units coming out of the country of Indonesia. Looking back to 2024, down near those troughs, you can see that the market share for Indonesia at that point in time was a measly 5%. In the last few years, they've grown that all the way to 55%. So Indonesia is very much becoming kind of the one-stop shop for the globe's nickel needs. There are even expectations that as we get into the later parts of the 2020s, by 2029, it's expected that Indonesia could be 75% of the global production of nickel. Now, great for Indonesia, who's essentially utilizing their resource base to kind of move from a third world country into a stronger player within what could be a very growing industry with electrification. The downside for nickel prices is they've brought this production online so fast and so robustly. Basically, in the last six months and in the next 12 months, it's expected that Indonesia is going to add about 30% of new supply into the global nickel market. I think what's happening is you've got this scenario whereby, at least in the short term, the supply ramp up is just outpacing these electrification needs, which may go into EVs and wind farms and things like that. I do think that those trends are going to continue to grow on the demand side, but those are 5, 10, 15-year scenarios. This production ramp up has taken place over the last 6 to 12 months. So I think it's just creating this mismatch of too much supply a little early for the demand side of the equation, and that's causing prices to be depressed. As we think about where we could bottom, I do think there could be a bottom on prices if we see things get down into the low sixes. That creates a scenario whereby prices get so low that a lot of producers say, we can't keep making money here, we have to shut in production. And then you could start to see supply-demand dynamics balance out a little bit.
Basic question here, does the price of nickel coincide with the price of stainless? In other words, if we see these fluctuations in nickel, does that necessarily translate directly to stainless prices, or do other factors contribute to that?
So it remains the case at the present time that the vast majority of the demand of nickel is going into the stainless steel industry. So without a doubt, if the stainless steel industry is strong, whether that's due to appliance sales or whatever end market may be booming, we would likely see that impact nickel prices broadly. If we refer back to that original market share or I guess market growth slide, which is showing which economies are doing well, which ones are weak, at least within the United States, unfortunately, one of the weak ones right now is household appliances, which is a major consumer of stainless steel. So there is, for now, a bit of softness on the stainless steel market. So it isn't helping the overall picture of supply-demand dynamics. But absolutely, if we see some of those trends turn the corner and see the demand for stainless steel really pick up, I would expect that to be supportive of nickel prices.
Yeah. Okay.
Looking at the supply-demand balances, I tend to agree with this view, which is we've got a lot out there. We're going to see surpluses for the next several years. The good news in this is it does look like the robustness of those surpluses appear to have peaked in 2023, at least per Macquarie and several other bank analysts. But they're surpluses nonetheless. There's too much nickel out there for the current needs. The expectation as we roll through the later 2020s, maybe we can get some end markets to pick up and help to consume some of those excesses and actually get that more to a balanced market. But for now, it's looking like there's a bit too much nickel flowing into the economy. Now, I tend to be of the opinion that I don't really agree with this, at least not in the short term. These are the bank analyst forecasts, and currently sitting in the low sevens. The bank forecasts are suggesting we could see roughly 10 to 15% of inflation over the next few quarters. I tend to believe we need to see a little more pain and a little more production curtailing before we actually get to see that bottom. So maybe I don't disagree with the endpoint of these charts, but I think I would probably say it's got to trough out a little bit before we see that upturn. My personal opinion. Switching over to the last commodity, although I do have one copper slide. there has been no shortage of excitement within the carbon side of things. Over the last 3 to 4 months, we've seen the price of steel within the United States move higher by almost double, going from, let's call it 650 on hot roll, all the way up to $1,100 in the last couple of weeks. When you compare that to the price of Europe, which is shown in blue, or the price of China, which is shown in orange, those regions are seeing a little bit of inflation, but it's nothing like what we're seeing within the United States. So what in the world's going on to have caused this craziness within the carbon landscape? Well, the first thing is we have seen raw materials. We're looking at busheling scrap shown in the white line, which has gone from about 380 all the way up to about 550 in the last couple of months. We've seen iron ore prices go from 100 to around 140. So those are creating a cost push scenario for the price of producing steel. So that has helped. We have also seen production levels at the steel mills been fairly subdued. You look back relative to 6-7 months ago, basically midsummer of 2023, production levels are still restrained relative to those types of levels. So, whether that's purposeful or not, there have been a lot of outages, a lot of maintenance that's taken place in Q4 at the mill level. We've talked about this in the past. There's also been a lot of consolidation at the mill level. Right now, there are 4 to 5 big players. There used to be 8 to 10. So the ability to kind of pull the levers to control production levels, it's much more powerful now when you've got fewer players. So I don't want to call it an oligopoly exactly, but certainly they have more power because there are just fewer players to compete. So by them keeping production levels a little more subdued, I think that it's helped to tighten markets a little more exceptionally than normal.
What you're showing here is tonnage, right?
This is tonnage. That's right.
Yeah, because utilization rates, we'd say, right, are hovering around like 75% range.
Yeah, that's right. And great question, because there is a reason why I pulled out the utilization rate, and that's because right at the beginning of the year, the AISI, which is the entity that actually constructs the production data, both the tonnage data and the percentage, they pulled out 2 mills. I believe it was Granite City and Republic that got pulled out of the calculation. So what that did was it took the denominator, it changed it, and it caused the percentage to do something kind of wonky. So I didn't want to show the percentage because it makes it look like things ramped up a whole lot more than they actually did. So if we just look at it on a tonnage basis, it's moved up a little bit off the bottom we saw just a couple weeks ago, but not massively. And then lastly, the other thing that's helped to tighten or keep markets a little tighter was import levels are very subdued as well. We unfortunately, the Census Bureau data is a little in hindsight, so this is only through October. I would expect that imports, when we see the new data, will ramp up in November, December, January, because domestic prices have run up by so much. But it doesn't feel like a whole lot of people are taking a ton of risk in going out and buying cheaper imports. And part of the reason for that is because imports tend to have very long lead times. If you're going to go out and you're going to buy imported steel, you kind of have to have insight or thoughts about where the market is going to be 5-6 months out. And we'll obviously have a slide that'll give you what the market's current perception of where prices may be 5-6 months out. And it's a little scary. And that is the chart right there. This is the hot roll coil steel futures. The orange line is as of current. The green line is as of March 31st of 2023. Now, why am I showing March 31st, 2023? It feels like we're in a very similar situation to where we would have been late Q1 of last year. And if we reflect back on where we would have been, there were points in time in Q1 last year where you couldn't find that next ton of steel. The mills basically said, we don't have it. We don't know when it's going to be available. Lead times were really extended. And prices were shooting up. It was basically name your price for the steel mills, and people were paying it. Unfortunately, some of the dynamics that created that, stockpiling and maintenance and outages and low levels of imports, at some point those things can turn. And at some point, the steel mills say, hey, now that we have prices at $1,200 and we're making all this money, we should probably ramp up production and capitalize on these higher prices. It feels like we're in an environment where we may see something play out like that again, where even though we have seen raw materials move higher, scrap is up by a couple $100, iron ore is up by $40. Yes, they're higher, but they're not high enough to substantiate $1,100 steel for the long term, in my opinion. So we did see lead times push out. A lot of that was coming by way of, service centers, end users stockpiling when prices were down in the 600s on hot roll. And that did push out lead times, but it feels like we're beginning to see that turn. And the futures market is very much so screaming from the hilltops. They think the party is going to be ending in a somewhat robust way, because as we look at the CRU, most recent data points have been hovering up near $1,100, but they're beginning to turn. And the futures market is saying we could see a couple $100 of deflation here in the coming months. What's interesting, I created this chart on Bloomberg, it's like a custom index. Basically what this is the price to lock in steel prices for 12 months. And quick plug, I am the director of risk management. This is what my team does. We do a lot of hedging strategies in steel, in aluminum, in stainless steel for our customers. And so this is basically, if a customer wants to lock in steel for 12 months into the future, this is the pricing at which they can do it indicatively, roughly within a couple bucks. You can see that it's been a roller coaster ride for where we've been over the last couple of years. That 12-month hedge price has gone all the way up to $1,600 when we had the massive supply chain issues. It shot back up there really quickly, if only temporarily, when the Russia-Ukraine invasion occurred. And then you can see the last wave, which would have been Q1 of last year. It tended to be a little more muted. Basically, the market was saying, yeah, the spot price is going up really massively, but the futures market kind of wasn't buying it. And even more so this fourth time around. It's sort of one of those things where it's like the market's been fooled 3 times, and it doesn't look like the market's willing to be fooled this fourth time. So even though we saw spot prices go from $600 to $1,100, the futures market never got up there. It never even got close. It got up to maybe 925, 930, and then already we're beginning to see it turn lower. The good news for customers who want to look at risk management is all of this is already being built into the price. So if you're an end user and you hate volatility in your cost structure, we can help you take out some of that volatility. And right now, the pricing at which we can do so, at least in carbon sheet prices, is heavily discounted to where the current spot price is. So keep that in mind as you're thinking about your cost basis for 2024. This is one that I believe is new for Cup of Joe, but this is looking at hot roll coil steel prices. So basically some of the same charts we've seen in prior slides. That's shown in the pink. We've got tubular prices, which is shown in the light blue. And then we've got plate prices, which is shown in green. What I first want to do is look back to 2010 to 2020, which is all of these markets were fairly well correlated for a very long period of time. They weren't exactly lockstep with one another, but for the most part, sheet prices moved with plate prices, which moved with tube prices. And in a lot of cases, it makes sense because the way in which you make a lot of these products is very similar. The raw ingredients are very similar. A lot of the production processes are similar. They're not identical, and I want to be accommodating to that idea. There can be end markets that cause things to gyrate in different ways than other products. But what we've seen in the last couple of years is a very substantial divergence between sheet prices, tube prices, and plate prices. And you can see it very distinctly. They've gone different directions. Tube's been a little more correlated to steel, and I think that kind of makes sense because you really aren't making tube unless you have hot roll substrate going into it. But plate prices deviated heavily. And over 2023, we had a chance to sit down with a commercial salesperson from Nucor, and he told us that market was just a different market and had different end market dynamics that allowed it to diverge. In my opinion, I think 2024 may be a year where we see a convergence of these 3 markets. We may see some of these gaps get back to normal where things tend to correlate a little more closely to one another. That may be by way of steel plate prices continuing their descent a little closer to sheet prices, and then tubular prices tracking carbon sheet a little more closely as well. So I think 2024 is going to be the year of convergence, not divergence for carbon products. And then last but not least, Ryerson doesn't do a whole lot in the copper world, but since we've covered forecasts and other products, I wanted to quickly touch on copper. The expectations among bank analysts, among the mean and the median forecasts, is slight upside, I'd say 10 to 15%. And this one I actually can get behind. I think there are a lot of end markets, both within Asia and the Western economies, that look pretty supportive of copper prices. That's things like, computing power, data farms, technology infrastructure in Asia that look like they're going to remain strong even in the face of a potentially softening broader economy. And then we do have the extra added element of First Quantum, which is a large copper miner. They have a copper mine down in South America that recently got closed down by their president, and it represented about 3% of global demand, or I apologize, global supply of copper. So that's a meaningful shutdown on the supply side of things, and that should help to keep the market a little tighter than otherwise expected. So with that, that is the conclusion of the Cup of Joe portion of Engage. It is a pleasure to have been part of this, and I'll kick it back over to you, Mike.
Great stuff. We normally do an hour on Cup of Joe. A great job kind of spitting it in here. A lot of interesting information. We come back first Thursday of every month, if you will, because we digest this data monthly and it's always changing. So on behalf of Nick, thank you for attending, and Allie, back to you for more of Engage 2024.